Yeah, Melissa, so Sharon and I were talking, and we're not here just trying to, read slides off to you.
Hmm.
Essentially, we'd like to give a little more knowledge, and if you have questions whenever I'm talking, whenever she's talking, feel free to ask them. Um, these slides are just more of guidelines. I hate when people just read them off and keep moving. So,
Right.
um, yeah, we can get started. Sharon, I think you're a man in the controls, so. I'm sure you're familiar with his better money habits at this point. How long have you been with Dress for Success?
Um, we were just talking about that. I'm trying to really figure it out. I think it was when I was pregnant with my son.
Okay.
So it's about 10 and a half years now, almost 11 years.
Yeah, okay, that's great. So then you're familiar with bettermoneyhabits.com. When you go to the site, each of those categories you can click on for more information. But today we're going to be talking about building credit specifically. So if you want to move to the next slide, actually, slide 4 has a nice overview of what we'll be talking about. And Melissa, I'm sure you're familiar with credit, but we're going to dive a little deeper into the specifics of it. So we're going to talk about building a good credit score, reading your report, which, by the way, you get one free report a year. We have a lot of clients who get emails and calls saying they just paid $100 to get their credit report. Well, you technically have a free credit report to get. So a lot of these companies set up shop just to make money off people. And then also we'll be talking about how to use a credit card responsibly. And do you own your home, Melissa? Do you have a credit card? Do you have a car? You familiar with credit? How familiar are you with it?
I'm pretty familiar. I don't have a home.
Yeah.
I've been kind of thinking about it a little bit.
Okay.
But, I have a couple of credit cards and
Okay.
I had a couple cards that I paid off.
Yep. Okay. So before we even get to the next thing, you're familiar with how important having a good credit score is.
Right.
Um, but what I would tell you is, it was at least 15 years ago when I started getting interested in helping people with financial education. And I walked into one of my mentor's office, and he was talking about money at the time. And he said, look, if you take anything away from this meeting, it's money is a tool. So I would tell you that a credit card, credit in general, is a tool. You've never seen somebody be used by a hammer. A hammer is a tool, right? People use hammers to build things. I've never seen a hammer turn around and start using somebody
Right.
to beat a nail with. So that's how you really want to think about a credit card. It's how you want to think about your money. You're in charge of it. It's a tool that you use to build your future. So you can use it to build yourself in order to apply to buy a home like you plan on doing in the future. To get a car that you already have, to have some credit cards. You use these things as tools for yourself, and it's not the other way around. So if we go to the next slide, please. This slide here. So you've done it already. You've applied for loans. You've applied for credit cards, and the companies are pretty quick to label you with, oh, you have good credit, you have poor credit, fair credit. Um, Another thing I'd harp on is don't don't identify yourself as the score. They say poor, they say fair. I wouldn't identify yourself as anything with your score. If anything, if you come in the poor category, if you're in the good category, all you want to think of yourself is improvement, needs improvement. And I can tell you from experience, I've had my own credit score in the 400s, and I've built it up to over 700. So I'm very well versed, and I have experience with these labels. You know what I mean, that they put on you. So don't identify with these labels. Just if you need improvement, you need improvement, and we're here to talk about how to improve that. So if you go to the next slide, here's what your credit score breaks down to, I would focus on the two on the right. So your payment history, that's very important. And you know that, that's obvious. Now, the amounts owed, though, is something that people overlook. So that 30% is actually, it means two things. So companies will take 30% of what you owe. They take that into the overall factors. So it's very high factor as to what they put your credit score at. So how likely you are to get a loan. But the 30% is also important because you want to be using less than 30% of what you have. So if you have a credit card with a limit of $1,000, you always want to be using less than 30% of that. Not a lot of people realize that that has a huge factor. So a lot of these companies will look at your score and they're essentially analyzing your score once a week, I would say. You don't see it, but it's going on in the background. If you signed up for anything like Credit Karma,
Mm-hmm.
things like that, you'll get a weekly update on your score. If you're under 30%, you will notice your score jumping quite a bit, actually. If you're over that, you'll notice it fall as well. So this is the breakdown right here of what they're looking into. I wouldn't worry too much of your length of credit history. Um, you sounds like you have some experience with it. They don't factor that too much in, but the obvious ones are payment history and the amounts you owe. So if we go to the next slide here, these 3 points here, all pretty obvious. The one thing I'll say about paying all bills on time, when I was making the climb, I think the lowest my score was like 430 or something. It's embarrassing to talk about, but I'm more than happy to help people improve the score because I've done it. This pay bills on time. At this point, everything I have is automated. Any payment that I have, it's automated. It comes out automatically, and it's also more than what the minimum is. And in a couple slides, we'll go over that. But that's the most important thing you want to remember. Just if you automate it, you won't ever forget about it. Check your credit report. I talked about that earlier, and you get one free, maybe even two, but I know it's one for sure. One free credit report a year, and then use credit responsibly. That's just obvious. So we go to the next slide. So for your credit report, Melissa, have you ever pulled up your own credit report?
Yes.
Okay. So then you know what you're looking at. Basically, you just want to look for fraud. You want to look for, oh, wait, there's a loan for an Audi on there. I don't even have an Audi. You know what I mean? You want to look
Mm-hmm.
for that kind of stuff. So once a year, make sure there hasn't been any fraud on your report. That way somebody else isn't using your good credit history, just so they can have something they want. We can go to the next slide. Yeah, okay. So key credit terms here. Credit utilization, that's when I was telling you about the 30%. I noticed my score jumped up a lot when I started using less than 30% of the amount that I had. The prime example, I have a credit card with $1,000 limit. If I use less than $300 on that and I pay it off monthly to zero, you will notice a huge, huge impact on your score. And the next two things are the difference between a hard inquiry and a soft inquiry. So the hard inquiry is something that's going to show up on your credit report as a company, say Bank of America, runs your credit so that you can get a loan for a car. That's a hard inquiry. You applied to the company so they can give you money for a car. That's hard inquiry. As opposed to a soft inquiry, which it does not show up on your credit report at all. So that's like Credit Karma, for example, providing you a free score every week. Well, those are soft inquiries. Or say you want to get pre-approved for a home. That's a soft inquiry too. It's not until the bank actually runs your social security number through the system that it becomes a hard inquiry. So you don't got to worry about soft inquiries too much. It's the hard inquiries. Say you have, 3 to 4 a year, that'll start to take a negative impact on your credit score. If we go to the next slide, I can explain to you what I'm assuming you probably already know this. The impact of not just making the minimum payments. You have an understanding of that, Melissa?
Well, actually, the I just got a deeper understanding recently,
Okay.
because I was on a call and the guy was talking about like loans and things like that, things of that nature, and
Yeah.
he literally said like I won't take anything over 5%, and I was like, what? Like I didn't know they went that low. I mean, all of my credit cards and loans and everything is like 25 or 24%. So
Yep.
hearing five, I was like, oh, just imagining how little money I would have to pay on interest and
Yeah.
things of that nature and APRs and stuff. So, yeah.
Exactly. And you know what else is kind of back to when I was telling you about my journey trying to improve my score. I had no idea when I called these companies, for example, my my very first credit card was with Discover. It was actually a student credit card. It was a secured card. We'll get into that later. But I called them and I said, "Hey, can we lower the rate?" And they cut it in half. It was just a simple phone call. I had no idea they would do that. So that's something to think
Wow.
about. But for example, this slide is just explaining how credit card interest adds up. So what the company wants you to do is pretty much pay the minimum. That's why they set the minimum,
Mhm.
because they run the calculation and they say, look, we can have this customer with us, if you're looking at the slide, for more than 17 years. Okay, now you're just paying $65 a month, $65 a month. All right, your total interest that you're going to pay over that time is $3,000. So the total cost to you will be 6 grand. That's what they want you to do. Okay, so that's the credit card using you as a tool. Back to my example. Now, if you go ahead and even don't even worry about the 100 to 200, because when I was building my credit, I couldn't afford that. All right, so instead of 65, I put 70. That's still that will still cut your payments and the interest that you pay over time significantly. And then when you eventually you start making a little more money at your job, you put another $5 or another $10, and I'm telling you, you start using the credit card as a tool, and it's not the other way around. The companies, they want you to pay the minimum, and this right here is pretty obvious why. They just make a lot more money off you. Can you see that, Melissa?
Right. Yes.
Okay, let's move on to the next. All right, key takeaways here. This is some things that she's going to dive a little deeper into. You already know what your credit score is and why it's important to have a high one. We'll talk about it a little bit more. You'll probably have more questions when we're done about how to build it, specifically, how I did it or how other people can do it. And
Right.
checking your score for free every year. Don't pay for it. It's free. And I can't even see the fourth one, but
The fourth one is you use credit responsibly.
yeah, another obvious fact. So we'll move on to the 13th slide, and I think Sharon will start taking it away from here for you.
Yeah, so with all the information that Dom has presented, so what does this mean? So what does credit score mean to you, and how do you use it so that it serves you instead of you becoming you serving them in a way? Just like the slide, I think it was this one that
Yeah.
Dom pointed out with all the interest that you would pay, right? So now how can you use the score, and now that you understand how this credit scoring works, how do you use that to serve you? So what does it mean when you have a good credit versus a bad credit? So on the left column right here, can you guys see my cursor right here or no?
Yep.
Yes.
All right, so the bad credit is on the left-hand side. So what does that mean when someone has a lower credit score? That means higher interest rates. For example, instead of 6.99%, you're probably paying 18%, 19%, 20%. And I was working with a client who actually has 3 credit cards outstanding, and he's got great credit score. However, with the amount that he was owing, it was way more than the 30%. And he was teetering around 17, 18, 19%. So we're looking at debt consolidation, how we can refi that into a lower interest rate. But so back to the bad, lower credit scoring, higher cost in lending, and it's harder to get approved if you need to have additional credit to buy something versus if you have a higher credit score. Then the cost of lending will be lower and it'll be easier to get approved if you need additional line of credit. And the monthly payment on the left-hand side is if you have lower credit score. So potentially higher monthly payments. And that's just simply because, you use the outstanding amount owed on the credit card, multiply that by the interest rate, right? So if you have to pay 20% in interest just to use that money versus someone else who's paying 5% interest rate, that is huge, especially over time. And so what does that mean? That means less money in your pocket because you're paying more toward the interest. You're paying more to just use that amount of money versus if you have a higher credit score, that means potentially lower monthly payment. So a bigger chunk of your monthly payment will go toward paying down your the amount of balance owed, and also potentially more money in your pocket. Does that make sense so far?
Yes.
Okay. So for key credit moves for 20-somethings, I think these 4 points, this is, the next 4 slides, these are just good tips for all ages, not just people in their 20s. They're people who are in their 40s, 50s, and 60s, and they might just be learning this for the first time, right? So the first point is to pay your bills on time and in full. That goes back to what Dawn mentioned earlier. So when you develop that habit, then just having the discipline to say, okay, I'm going to pay this in full first. I'm going to take care of this first before spending the extra money on my wants. Sometimes what I see is people get into the habit of spending money on what they want and then only use what is left to pay down their bills. And if you do that over time, it could develop a habit of not paying your bills in full or lagging in payment. Eventually that would hurt your credit score. And second is consider a secured credit card. And what this is, and I just learned this from Dom actually, is that, and I think this applies to people who are just starting out. They don't have a credit card payment history. So to start out, they could have a secure credit card. What that means is that if they wanted to have, say, a line of credit of $500, they could deposit that amount with the bank. And the bank would give them a line of credit of $500, which they would use, say, spend, $20 here, $20 there, and then at the end of the month, if you pay that off, and over time you develop the habit and also the payment pattern of being able to pay off the amount you owe every month, then that would demonstrate to the bank that you have the discipline to keep up with your payments. And then, so at some point they will remove that requirement and give the $500 back to you and say, now your credit card is a true credit card that runs off of your credit, which is a promise to pay, instead of it being secured by the money on the back end. So that's a good way to get started, to start building that payment history, and that habit of paying off your credit card. And the third point is don't use all of your credit. Dom mentioned this. From a credit reporting perspective, you want to keep the usage, below 30%. And fourth is to check your credit once a year. And you get free credit report once a year. Dom also mentioned this earlier, that some people think that they have to pay for it, but no, actually you don't. You're entitled to one free report annually. So that pretty much concludes the slides. What questions do you have?
So I didn't know that about the secure credit card.
Mhm.
But it turns into a regular credit card afterwards, after you've shown good faith.
Yep.
Um, how does that process work? Will it be like credit limit increases still,
Yeah.
like a regular credit card, or?
Yeah. So I've had a secured credit card when I was trying to rebuild my credit. The very first one I had was for $200, and I gave the company, it was Capital One. I gave them $200, and they gave me a credit card. It's essentially a checking account, but with credit attached. So you give them the $200, they send you a card, and you can use that card for up to $200. So all I did was I just bought gas on it. That was the only thing I used that card for, was gas. And every time I got gas, I'd pay it off immediately because, at the time, and it's still pretty cheap now. It's actually cheaper now than it was. But I paid the gas off right away. As soon as I used it on the credit, I made the exact payment to zero. It took about a year, and I called them and I said, "Hey, I haven't missed a payment. I always pay it off. I'm always under 30%. Can we switch this to an actual credit card?" They bumped the limit to an actual credit card to $3,000. So it went from a secured credit card to unsecured. My credit score improved over the year, and then I had an actual credit card because of the year of making timely payments. That's essentially how it works. They hit a button. They see that you've been reliable. Your score is increasing, and they hit a button. Essentially, it turns over to an unsecured credit card. They increase your limit, and you go from there. They give you back what you deposited to. So they sent me a check for $200. That's how it works.
Okay, I was curious about that because
Yeah.
I didn't know that it could be changed over and
Yep.
a real credit card. So that's cool.
Mm-hmm.
Um, is there an age for like adding an authorized user? Like,
18, yeah, 18 years old.
oh, it is 18. Okay.
Yeah, yeah, 18 years old.
Okay.
Um, yeah, they usually call it the age of majority, but technically it's 18.
Okay.
Yep.
And then you said you can call for a lower rate. So, like, how does that conversation go?
Yeah. So it goes like this. You call the company, and if you've actually been making your payments, you have that to leverage. So you call them and you say, "Look, I've been a loyal customer to you guys for 6 months or 8 months, 9 months, a year, and I've been making a little bit more than minimum, or I've been making my minimum payments on time." If you have auto pay set up, that works in your favor even more. They say, "Oh, I see you're on auto pay," or they'll say, "Oh, yeah, we've noticed you've had a payment streak of, on time payments of 12 months." And then that's when you say, I'd like to talk to you about lowering my interest rate. And here's what you say though. You say, "Can you cut it in half?" Because usually they'll say no, but
Hmm.
just say half. At the time, I was at like 27%. You know,
Yeah.
and I said, "Just cut it in half." And they said, "Well, it's a little too much." I said, "Fine, okay. How about 18%?" You know what I
Hmm.
mean? So you're not really looking to get it cut in half. You're just trying to get a little more room for negotiation.
Right.
Um, so they'll probably tack on a few percentage points above half. But over the long term, you'll be saving yourself a lot of money. You know,
Yeah.
that's essentially how it works. And if they say no, ask them one more time. Say, "Well, I just got an offer from a different company asking to consolidate my debt with them at a lower rate." At that point, they'll say yes. Even
Hmm.
if you have to make it up. I made it up plenty of times.
Yeah. That's how I do the cable people.
Yeah, exactly. AT&T just said, $40 a month, that's
Yeah, I
200
mean,
dollars a month.
hey.
Yeah.
They always find something, right?
they don't want to lose your business. So I would use that as a last resort if they say no, but they'll say yes.
Okay. And can you do that with credit cards and loans?
Yeah, yeah, you can. Yep, I've done that with my car loan actually recently.
It never hurts to ask.
That's right.
You know, it never hurts to ask. If you don't ask, you get no, right? The default answer is already no. If you ask, they may consider it. You would come out ahead.
Right.
And you know, the honest truth of it is not a lot of people are asking. So they're probably just going to be surprised that you even asked in the first place. So you're most likely you'll get a yes. You just have to ask.
Yeah. So what I've done is that every once in a while, I would get a credit card offer with balance transfer of 0% for 15 months. As a matter of fact, right now, I think us, Bank of America, we have a card. I think it's cash rewards card, 0% for 15 months.
Yeah.
And then with a transfer fee of 3%. And so instead of moving my balance, I would say, well, you know, this is the offer I get. So would you match that? Talk
Yep.
to the existing credit card company. And very often they would do that because they do not want to lose your business. That relationship is there. They want to do whatever they can to preserve that relationship with you.
Right.
So is there like well, I know you said that you showed me the percentages, but is there like a hierarchy or something like so if I have something in collections and
Mm-hmm.
I have maybe 70% on my credit card, and
Mm-hmm.
then I have a loan that's 27% interest that
Yep.
has a high balance. Like which one, if I only have $1,000,
Yep. Yep.
which one should I put my money on first?
So you always want to focus on the highest interest rate first. That's what you want to focus on. Now, if you have something in collections, that's you call the collection company and you set up like a monthly deal with them, say $50 a month that they take out automatically, an e-check or something. Um, but you want to go with the 27%. You want to go with the highest interest rate because over time that's going to cost you the most. Whatever's in collection, you can pay that off, through a monthly program. But if you have something with a really high interest rate, you want to call them first and you want to start there first.
I think that strategy is called snowballing.
Yeah.
Yeah.
Mm.
So you just knock out like one card at a time.
Right.
Yeah.
So, and then, so, say, I fixed my collections, and after I fixed the credit card limit and, paid a loan down or whatever, and then I kind of get my credit score up. Is there a number of cards I should have, as far as like, just normal, responsible credit cards?
Yeah, that's a great question. So here's how I look at it. I wouldn't look at it as the number of cards you have. You obviously you don't want a lot of cards, but what you're looking at more is your overall credit utilization. So say I have 3 cards, $1,000 each. That means I have $3,000 of available credit.
Mm-hmm.
All right. I don't ever want to spend over $900 on those 3 cards put together. Okay.
Mm-hmm.
Now you can also have 10 cards with $300 each. Okay, that's still $3,000 credit limit. You still don't want to go over 30% of that. Okay, so it's not really the amount of cards you have. When it comes into consideration is the amount of cards you apply for within a given amount of time frame. So say I apply for 3 cards within 1 month. That's going to affect your score way worse than if you apply for 3 cards over 1 year. So you're kind of showing them that you're more in desperation mode. I've done that in the past, and my score dropped significantly, as opposed to waiting over a year and applying maybe 1 card every every 8 months, every year or something. That looks better. So you can have a lot of cards. It just really comes down to how much of the card you're using. And to that point too, I would say don't close your cards either. Because when you close your card, just because it has a zero balance, keep it open. If you close your card, now all of a sudden you had a $3,000 limit. Now you close the card because you don't use it and you figure out why not. Now all of a sudden you have a $2,000 limit. And people don't realize that that actually negatively affects your score because now your credit overall shrunk. So if you leave it open, you're not going to use it anyway. Just leave it open. That shows that you still have more responsibility because you never even touched that portion. A lot of people just close things when they shouldn't. They should just leave it open and not use it. That's kind of how I would approach that.
And then, so I've heard that if you don't use them like at all, then some places close them.
Yep, that's true. My response to that would be gas. Just once a month, just throw gas on there and pay it off. I mean, it's super cheap, $25-$30. They think you're using it all the time because it's just an algorithm. That's all they use. So the system thinks you're using it responsibly. Your credit score is going to go up a lot if you do it like that, as opposed to never using it. Because in the past, I've had a company, Discover, actually closed my card because I never used it. I thought I was being smart. You know what I mean?
Right.
And they just shut it on me. So yeah, that's how I would approach that.
So is it better to get the gas? And I mean, of course, most of the time it's pending. So wait till it posts to the actual credit card and then pay it, or wait until the statement comes out?
Don't even wait till a statement. They know that you're using it. I would get the gas in a couple of days, I'd pay it. Or if you know you're only getting gas, you can set up an automated payment just for the current balance is what you'd want to choose. Current balance, because it's always going to be a low amount. So that amount, the current balance, will always come off in less than a month. That's two ways you can approach it.
So like with auto pay, I know it comes out on the due date, right? So will it still charge interest and stuff if it comes out on the due date?
No, because it'll be before the statement cycle. So you're essentially given like a month-long cycle. If you pay the balance off before that, you won't be charged interest. That's pretty much how it works. Just to be safe, I usually like to keep things paid off within 2 weeks. Yeah, I would say 2 weeks of when you get the gas. I would just set it up because you can set that up in auto pay. You don't have to make it monthly. You can say say you want it to go in the mid-month instead of waiting until the statement cycle. That way, on June 1st, when I get my gas, it's paid off on the 12th of June, and you can just continuously have that go monthly before the cycle even starts. That's one way to approach it.
And something that I've done on my side is that with, say, my second paycheck, my paychecks come in on the 15th and the 30th of every month. So and most of my credit cards would have a due date somewhere between the 10th and the 15th of every month. So with my second paycheck of every month on the 30th, as soon as I receive that deposit, I would go in and pay off all the credit card balances that I owe. So develop that habit, have it on your calendar so you log in and do that.
Okay. So if say I have I mean, in the perfect world, I have like one of those unlimited credit cards, that those mythical creatures that are out there somewhere.
Yeah.
That black card.
Yeah, the
The
black card, exactly.
right.
So say I have one of those and I only do gas. Does that still, trigger the algorithm to be like, oh, it's still active, or is it
Oh yeah.
because
Oh yeah.
it's such a low amount?
It, it's under 30%. So no matter what, it's going to help you. You could have a credit card with $1 million limit.
Hmm.
It doesn't matter if you're just paying gas on it. Your score is going to increase. Your score is always going to be solid. You may get calls. If you have $1 million limit on a credit card, they may be calling you saying, "Hey, you want some travel points? You want to use a little bit more?" You know what I mean? But it's your credit card. You can use the credit up to whatever you want. You can use it smartly, or you can just not. So keep it under 30%, pay it off before the month ends, and that's how you use it to build your future, as opposed to the other way around.
Okay.
So Dom, would that be like a trade line? I've been hearing about people getting trade lines to improve their score, but they would have
Straight
like
line
maybe
as
10
opposed to revolving.
a, a trade line. It's like a credit card with a $10,000 limit that I guess you may have to pay a fee into, but they'll issue you the credit, like even if you don't have the best score. I don't know if you've heard of them, but
I have heard of that. I don't have much experience with that kind. It
okay.
sounds more of like a personal loan that they then give you a card to use. So they kind of use two different. It's essentially a personal loan, but to make it feel more like you're able to use it whenever you want, they give you a card. But really, they just gave you a loan for 10 grand. So that's more of a. You said straight line or trade line?
Trade. I think it's
Trade. Yeah, trade.
you're talking about, Bridget, where so it's basically somebody that has had a credit card for like 20 years or something like that. They've had impeccable payments and all of this stuff. You pay them to be added as an authorized user. You never get a card or anything like that. And that's supposed to help. But I always wondered with those, if you get those like that, I mean, eventually they're going to kick you off. I mean, you're not going to keep paying them forever. So when they kick you off, that's going to really mess up your score, right? So is it even worth the difference?
Now,
Yeah, I
see,
mean,
I've heard of ones where you're not attached to anyone's credit.
Oh,
But
I definitely haven't heard
this
of
is
that
all
one.
new to me.
yeah. Here's what I could say. It can work for you or against you, the whole adding an authorized user. So if I don't have a credit history and I'm added as an authorized user to, say, somebody who has a phenomenal credit score, that's only going to help me. Now the reverse is true too. Now, if I had somebody as an authorized user and I have good credit and all of a sudden they don't make payments, that's going to hurt me. So it could work vice versa. I'm not too sure about the trade line. I can look more into that for you and send you an email about it. But I don't have much experience with it, to be honest with you.
Thank you.
Yeah.
And a popular question from our ladies in rebuilding their credit.
Yeah.
Did you actually pay an agency, or were you proactive in making those changes yourself?
Back in the day, I had a couple agencies calling me about, hey, you have an awful credit score. You need help. You need help. You need help. Thankfully, during that time, I was becoming educated. I grew up in a family that we didn't know much about this kind of stuff in Youngstown. So I didn't have good habits. All right. I had to learn all this stuff the hard way. So it was during that time I actually got a job here at Merrill. Over 6 years ago at least. And I did it. I just did it my way. I did some research and I noticed everything that I just spoke to you guys about: 30% authorized user, more than the minimum payments, make it automatic so you don't have to think about it, calling them because nobody calls them, negotiating your credit score, negotiating bad payment history. I've done that too. I said, look, I've been good with you guys for over a year. Can you remove 3 of these late payments that I've had? And they did it. and I've noticed 50-point increase in my credit score with over 2 months because of that alone. So there's all these different hacks you can do. I did not pay an agency to do that for me because really they're only working for your money and they're not really working for your score, to be honest with you. I just never thought it was worth it. So I did it myself.
Okay. Thanks.
Yep.
Do you know how to like delete stuff? So, or does stuff like that fall off by itself? So
It'll
if
fall
I
off after 7 years. It'll fall off.
if I pay something in the collections and like it'll show up as paid now. So
Yep.
will that fall off in 7 years too?
Yep.
Okay. Then so is this 7 years from when the account was opened, or
It's
like what's the
7
7
years.
year?
It's 7 years from when the derogatory mark happened. 7 years from when you missed the payment. 7 years, from when you let an account miss a payment for 3 months. It's the starting date of whatever the bad negative thing happened. 7 years after that. Or you can call them too. I've seen a 50-50 shot with calling. Sometimes they just say nah. Other times they'll say, yeah, sure, we'll remove 1 out of your 3 late payments. And that helps significantly. In the 7 years, I believe I noticed the biggest impact when you have a 98%, 98% payment history. So you make 98% of your payments on time. That looks really good. You obviously want it higher than that, but bare minimum, that's what I noticed my store started jumping.
So if I again, this is butterfly world, but
Yeah.
so if I was able to save up enough money, and I decided I wanted to go and buy a car, so I go to the bank and I get a loan, and then go get a car. If I pay that loan off, most car loans are like 5 years or 3 years
Yep.
or whatever.
Yep.
If I pay that loan off in 1 year or like 7 months or something like that, is that bad, or is this still an improvement? Like, does that still look good on your credit score to pay something off that early?
That looks good. It's
Okay.
not bad at all. You don't have to do it. So they want you to use the term because they make the most money over that term. So they'll be harping on you just finishing up in 5 years, 5 years, 5 years. But you pay that off in 3 years. That looks good because you paid it off quicker. It's always smart to pay it off quicker than the term. It always looks good. They'll never tell you that, but that's what you want to do.
Because I was just wondering if it would lower the score again. Like I said, when you get the loan, sometimes
Yep. So what happens is, depending on how many times you've applied within a certain amount of time frame, your score will lower. 10, 15. I wouldn't worry too much of short-term fluctuations though. I would focus more on how many times I'm applying for something. All right. You don't want to be applying for something once a month. Once every 6 months, that's okay. But focus more on the amount of times you're applying. That's probably the best way to go.
And is it good to keep a loan with the same people? So
Oh, yeah.
like I have a credit union, so if I get a loan with my credit union and I pay it off, but now, okay, that was for debt consolidation. Now I paid off my debt. Now I want a car. Should I go back to that same company, or is it better to go to different companies?
It's always smart to shop around. So when you shop around, make sure that you're getting pre-approval stuff, not actual applications, because when you like the difference between the soft and the hard inquiry. So the pre-approval won't show up on your credit report, but the hard inquiries will. So when you shop around, always ask for pre-approval stuff. But I would definitely go with who I've been with for years, because you're most likely to get a good deal with them as opposed to somebody else.
So how do you do the pre-approvals? Do you just call and say,
Yeah.
hey, I want to do this. Can you give me a pre-approval?
Oops, sorry. Yes, that's exactly what you do. So one of two ways. I personally like to have somebody on the phone with me. as opposed to going online. Going online is another way to do it, but ask for a pre-approval letter is where you want to start, and you want to start by calling them.
Okay.
So, 1 minute, I need to check this real quick.
Any other questions, Melissa?
No, I think I think I got them all. It's very informative. A few things I definitely didn't know before.
Yeah, it can get overwhelming, but like what Dom said, and I've practiced this in my, when I deal with my credit card companies, is that just you can call. You can always just call and say, hey, can I have my credit interest rate lowered? And of course, by the time you call in, right, if you've had good payment history, you use that to back yourself up. So you can always ask for them to remove your late payment, and I've done that multiple times. I've asked for them to lower my interest rate, and whenever I get a 0% interest rate on balance transfer, I would take advantage of that. So there are things that you can do on your side to be proactive and stay on top of this, so that you can help lower your cost of lending.
And so if I wanted to do like a credit limit increase, is that a hard inquiry? Like if I call them for a credit limit increase, do they do a hard inquiry to see if I'm eligible, or?
Good question. I'll defer that to Dom.
So when I've done that exact situation in the past, you want to make sure that you call them first, because you have two options. You can go on the app or online, on wherever you go for the online site, and you can apply for a credit increase. Now, I wouldn't just straight up apply for an increase, because it could be a hard inquiry. I would call them first, because they'll be able to look at your history and they'll say, oh yeah, we can probably increase this 2 times. So from 1,000 to 2,000. I'd call them first. That way you're not just putting a hard inquiry on your report, because sometimes it could just be a soft. They have tools for that.
So if it is a soft inquiry, is it better to keep raising your credit limit with that credit card, or is it better to just leave it alone and just do the gas thing? I mean, I'm still going to do the gas thing, but is it better to, that they've trusted me with more money, or, for the score?
It's better. It's better if you call and ask them once a year. I wouldn't try, once a month. It's always better to have a wider, bigger range of credit utilization amount, a bigger credit amount. You don't want to stay at 1,000 or 3,000 or 500 forever. They want to see that you're responsible with a great amount of credit, and they want to see that improving over time. So I would definitely call once a year at least, maybe once every 6 months if you're feeling up to it. So yeah.
Do you ask them for how much, or you just say credit increase?
I ask them. I say, look, it's the same thing when I told you about the lowering the interest rate. I say I've been making payments a little bit more than minimum on time, automatically, for over 6 months, over a year. I say, can I double my limit? Ask for double. Just always ask for something extreme. You know what I mean?
Yeah.
Because usually they'll say no, because it's so extreme, it's outrageous, but you'll still get more than what you actually anticipated, because of how extreme you went. That's how I did it. I just went with the craziest ask. So.
I think that's it now. I don't think I have any more questions.
Okay.
I really appreciate this information, though. It's a lot of stuff that I aware of before. I mean, I am a millennial, so we forget sometimes the precious value of making a phone call.
Yeah, no, it's true. I mean, I didn't realize it until I started making the phone calls and asking for outrageous stuff. You know what I mean? They just said yes. So,
Yeah.
uh, yeah, I mean, if you have any questions, I don't know if you have our emails or my email, Sharon's email, but feel free to email us if you have questions.
I can get it to you, Melissa.
Okay, thank you.
You're welcome.
You're welcome.
You're welcome.
Thank you so much, Sharon. Thank you, Dominic.
You're welcome.
You're welcome.
You guys have a nice weekend.
You as well.
Well,
Yeah. Have a nice weekend, everyone.
nice,
Thank
safe
you.
week.
Yeah. We'll see you guys.
Bye.
Bye-bye.
Bye.
Bye-bye.